What if I told you one of the biggest cash flow problems in your business isn't a lack of customers? It's a lie you've probably believed for years. Today we're going to play a game, Two Truths and a Lie, Cash Flow Edition. So I'm going to give you 3 statements, and 2 of them are going to be true, 1 is going to be a lie. And if you're not able to identify the lie, it could be costing your business thousands or even hundreds of thousands over the lifetime of your business. So let's see how many of these you get right, so please keep score. So first, round 1. So I'm going to share the 3 statements. The first one is customers are the only sustainable source of cash. A loyal customer is one of your company's most valuable assets. And then also selling more guarantees that I'll keep more cash. Which one of these statements is the lie? You're right. Selling more does not guarantee that you get to keep more cash. Most business owners assume that more cash automatically assumes that they get to keep more money in their bank account at the end of every month. I've seen companies double their sales or even triples their sales, and they're still left wondering, where did all the money go? So let's see if you're able to answer this one right. So round 2. A profitable company can run out of cash. Cash problems usually start long before the bank account gets low. And profit and cash are the same thing. Which one is the lie? You're correct if you answered the 3rd option. Profit and cash are the same thing. This may be the most dangerous lie in business, because what actually happens is profit is simply the result of a math formula based on accounting principles, sales minus expenses. Cash, on the other hand, is the reality of whether you have money in the bank account or not. All bank accounts are the same, regardless of the type, whether it's your business, a personal, or even a nonprofit bank account. All accounts need more money coming in than going out. You can have a profitable company but still have customers that have not paid. You could have inventory sitting on the shelves. You could have loan payments that you need to pay, income taxes, owner distributions. The list represents the cash flow commitments that are often not reported on the income statement. They may be reported on your balance sheet. It just depends on how your financial statements are prepared. Round 3. Employees make money decisions every day. Small mistakes multiply over time and they can drain your cash flow. Cash flow is the accounting department's job. Which one of these is the lie? You're correct if you answered cash flow is the accounting department, because this is a lie. So when we think about the money decisions in your business, who's really making the decision? When someone gives a discount, who gives the discount? It's your sales team. Who approves overtime? It's the supervisor. Who orders inventory? It's the manager. Who makes repairs without charging for it and they're giving a gift to the customer? You're right, your technicians. Who collects money? Oh, that's the accounts receivable department, but they're probably the ones that are sending the email reminders or actually making the phone call. But who's really responsible for collecting money? Before you can collect the money, someone needs to send an invoice. Before you send an invoice, someone needs to provide the service that you promise. And during the sales process, someone communicates the payment terms. Even the person answering the phone and setting the appointment, and then the marketing message, all of those set expectations as well. The bottom line is positive cash flow is created long before the paperwork makes its way to the office. The accounting team records and reports what happened, but the team is the one that actually affects cash flow. So round number 4, which one is the lie? Charging too little creates cash flow problems. Every discount comes out of the company's pocket. We can make up low prices with more customers. Which one of these is the lie? You are correct if you answered we can make up low prices with having more customers. This lie is one of the biggest misconceptions in business. Relying on volume to increase cash flow rarely works. Service companies are primarily selling time, and there is a limit on how much time you actually have available for sale. And let's go back to the second statement. Even though it's true, every discount comes out of the company's pocket. Think about it. When you give a customer a discount, can you turn around to your supplier and ask for a discount? No. What about your employees? Can you go to your employees and say, hey, we given customer discounts, I need to lower your paycheck. Is that going to work? Definitely not. And then can you go to your landlord and say, I need to lower the rent payment this month because I gave a bunch of discounts to our customers? The answer is going to be no. There's a legal contract in place. And so all of the discounts impact the company's profit and cash flow. And so you really need to plan for the ripple effect that the discount will have. And then even if we look at the first statement, charging too little creates cash flow problems. This is true because your company's only source of money is from your customers. Yes, you can borrow money from the bank, and you can transfer money from your personal savings account, but the only long-term sustainable source of money is from your customers, and that is driven by your prices. When your prices are too low, it creates a money problem long before your team even starts working to deliver the services. Round number 5. Which statement is a lie? Income taxes are predictable. Taxes are a cost of doing business and should be included in prices. The goal is to pay as little income taxes as possible. Which one is a lie? You're right. The goal is to pay as little income taxes as possible is one of the biggest lies, and it can really hurt your business. This may sound a little bit strange. No one wants to pay more taxes than they legally owe, but paying less taxes should never be your primary goal. The goal is to maximize the money you keep after taxes. So here's an example. Let's pretend that you had a conversation with your tax accountant and they told you that you have $100,000 of profit and you're going to owe about $25,000 in income taxes. Would you rather spend $100,000 on equipment so that way you can zero out your profit and your taxes? You saved $25,000 in taxes, but you spent $100,000. So this works if the goal is to pay zero income taxes. Then you accomplish that goal, but the problem is you're left with zero money in the bank account. The other option is pay $25,000 in taxes so that way you can keep the difference of $75,000. Spending $100,000 to save $25,000 is not a tax strategy. That's a spending strategy that you're kind of given permission to spend from the tax accountant, and it's disguised as tax planning. The best tax strategy isn't simply paying less taxes. It's making great business decisions where you first think about the company at the big picture level, and then you structure the decisions based on how can you be as tax efficient as possible. So I encourage you, stop draining your bank account to reduce your income taxes. Round number 6, which one is the lie? Statement number 1, cash flow forecasting is a leadership tool, not an accounting exercise. Hope is not a cash flow strategy, and no one can predict cash flow. Which one of these is a lie? You're catching on? The third one is the most common lie. Nobody can predict cash flow. The truth is, cash flow is predictable. There's no need to predict the future perfectly down to the penny. That's not the point. Think about the weather. If the forecast says that there's an 80% chance of rain tomorrow, you're probably going to grab an umbrella. You don't wait until you're soaking wet. Cash flow forecasting works the same way. A simple cash forecast helps you see problems while there's still time to do something about them. And so when you're thinking about all of the different lies that we've covered, do you notice a pattern within that list? Every one of these lies causes business owners to become reactive. The truth is, cash flow isn't controlled by one big decision. It's made by hundreds of small decisions by everyone in your company every single day. That's why I believe the biggest shift a business owner can make is this: stop thinking of cash flow as an accounting report and start thinking of it as a leadership system. I read every comment, and who knows, your idea or story might even become part of the next episode of Cash Flow: Two Truths and a Lie.